The swoosh is on the jersey of almost every team at the World Cup. It's on LeBron's shoes, on Serena's dress, on the kit of every NFL team in America. For decades, Nike built the most recognizable brand in the history of sport. So here's a question. How is the company behind it worth less than TJ Maxx? Yes, TJ Maxx. The discount department store where you walk in for socks and somehow leave with a lamp. Nike is worth less. That sounds ridiculous. It also happens to be true. Nike's stock has fallen roughly 75% from its all-time high. Three of Wall Street's biggest banks downgraded the company on the very same day. Its own CEO stood in front of investors and warned them that the worst quarter of the turnaround was still ahead. But here's the strange part. Nike wasn't crushed by a revolutionary new competitor. It wasn't disrupted by some breakthrough technology. It wasn't even beaten. Nike handed its lead away. And that's what makes this story so fascinating. Because some companies fail because the world changes. Nike failed because it changed itself. To understand how Nike ended up here, you first have to understand what made it so dangerous. It wasn't the origin story. It wasn't Phil Knight selling shoes from the back of his car. It wasn't even the athletes. It was desire. Nike built a machine that made people want things they couldn't have. Limited releases, sold-out colorways, shoes people camped outside stores for, products that had waiting lists before they even launched. The Air Jordan 1, the Dunk, the Air Force 1. These weren't just shoes. They were status symbols. If you had them, people noticed. If you didn't, you wanted them. That wasn't an accident. Nike deliberately made fewer shoes than people wanted, because scarcity creates desire. The harder something is to get, the more people want it. And for decades, it worked. Jordan brand alone now generates around $7 billion every year. That's almost $19 million a day. Michael Jordan hasn't played an NBA game since 2003. Yet he still earns an estimated $300 million every year from Nike. For a player who retired more than 20 years ago, that's an extraordinary business. That's what happens when a brand becomes bigger than the product itself. Nike wasn't just selling shoes, it was selling identity. Owning a pair said something about you. And once a brand reaches that point, people stop asking, "Do I need these?" They start asking, "Can I get them?" For years, that was Nike's superpower. Then, someone decided to change the formula. In 2019, Nike hired a new CEO, John Donahoe. On paper, he looked like the perfect choice. He'd run eBay, he'd led ServiceNow, he understood technology. There was just one problem. Nike wasn't a technology company, it was a brand, and those are two very different businesses. The board believed Nike's future wasn't selling more shoes. It was owning the customer. Instead of selling through thousands of retailers, they wanted people buying directly from Nike.com. More customer data, higher profits, complete control. On paper, it looked brilliant. In reality, it quietly dismantled one of Nike's biggest strengths. The strategy was called consumer direct acceleration. In simple terms, Nike started walking away from the stores that had spent decades building the brand. Between 2020 and 2022, Nike cut around 50 major retail partners, department stores, running shops, even Foot Locker, one of Nike's biggest partners for more than 30 years. They even walked away from Amazon. The thinking was simple. Why let someone else sell your shoes when you can sell them yourself? Every shelf Nike left behind was quickly filled by someone else. And once customers try another brand, there's no guarantee they'll come back. But pulling out of stores wasn't even the biggest mistake. Because while Nike obsessed over where people bought its shoes, it forgot why people bought them. Innovation slowed. Instead of launching exciting new products, Nike kept relying on the same three shoes. The Air Force 1, the Dunk, the Air Jordan 1. These shoes became icons because they were difficult to get. Nike's solution was to make far more of them. Hundreds of colorways, constant releases. Soon, the shoes that once sold out in minutes were sitting on shelves. Then outlet stores, then discount racks. Nike had accidentally turned collectibles into inventory. Analysts put it even more simply. Nike became so focused on where it was selling that it forgot what it was selling. Investors weren't impressed. A class action lawsuit followed, alleging Donahoe had misled shareholders about the strategy. By September 2024, he was gone. But by then, the shelves he'd emptied had already been filled. While Nike was busy pulling products out of stores, something else was happening. Those shelves didn't stay empty. 3 brands that most people had barely heard of a few years earlier suddenly had front-row seats. On running. Hoka. New Balance. They didn't invent some revolutionary technology, they simply accepted an opportunity Nike had created. Take on running. Revenue grew from $832 million in 2022 to $2.6 billion just 2 years later. Roger Federer invested. Serious runners started wearing them. Then everyone else did. Hoka followed a similar path. Revenue climbed from roughly $900 million to more than $2.2 billion in 3 years. And New Balance, once famous for dad shoes, became genuinely fashionable. Here's the important part. These companies didn't steal Nike's customers overnight. People simply tried something different. Maybe their local running store recommended Hoka. Maybe On was sitting where Nike used to be. They bought a pair, liked them, then bought another. That's how market share disappears. Not all at once, one customer at a time. Nike had spent decades convincing runners to trust specialist running stores. Then it left those stores. The advice stayed. Nike didn't. But Nike's problems weren't limited to the challengers. Because while On and Hoka were growing, Adidas was preparing for one of the biggest moments in running history. In April 2026, Kenyan runner Sebastian Saw crossed the finish line of the London Marathon in 1 hour, 59 minutes and 30 seconds. The first officially recognized marathon under 2 hours. He was wearing Adidas. Second place? Also Adidas. The women's world record? Adidas again. And that's what really hurt. Because breaking the 2-hour marathon was supposed to be Nike's story. Back in 2016, Nike launched Breaking 2. Years of research, millions of dollars. And in 2019, Eliud Kipchoge finally ran under 2 hours. An incredible achievement. But it wasn't an official world record. Adidas didn't need special pacers or a pace car. They simply did it, in a real race. Nike congratulated them afterwards. Professionally, it was exactly the right thing to say. Privately, someone at Nike was almost certainly thinking, that was supposed to be us. If losing shelves in America was painful, what happened in China was even worse. Because China wasn't just another market. For years, it was Nike's biggest growth engine. A growing middle class, hundreds of millions of customers, people who aspired to own Western brands. For a long time, that strategy worked. In 2021, Greater China generated almost 19% of Nike's global revenue. Then, it started shrinking. 7 straight quarters of declining sales. The latest quarter saw revenue fall 10%. Online sales dropped 21%. And management warned the next quarter could be down another 20%. At some point, a slowdown stops being temporary. It becomes the new reality. And once again, the problem wasn't just the economy. It was strategy. Nike repeated many of the same mistakes it had made in America. It pushed customers toward Nike.com and pulled back from local retail partners. The problem was, those partners understood China far better than Nike did, especially outside the biggest cities. As Nike stepped back, local brands stepped forward. Anta, Li Ning, companies that understood Chinese consumers because they were Chinese companies. Today, Anta is bigger than Nike in China. Then came something Nike couldn't control: national pride. A movement known as Guoqiao made buying Chinese brands fashionable, sometimes even patriotic. That's a difficult trend for an American company to fight. Nike also arrived late to platforms like Douyin, China's version of TikTok, where local competitors had already built huge audiences. And then there's something even simpler. Michael Jordan retired in 2003. For millions of young Chinese shoppers, he isn't a childhood hero. He's a historical figure. Nike knows it has work to do. It's investing in China again, opening research labs, designing products specifically for Chinese athletes, rebuilding relationships. The effort is real. The problem is that rebuilding always takes longer than breaking. And while Nike rebuilds, its competitors keep moving forward. So, where does all of this leave Nike? Let's look at the scoreboard. In November 2021, Nike's stock reached an all-time high of around $163 a share. Today, it's trading at roughly $42. That's a fall of about 75%. Then came another blow. On the same day, Goldman Sachs, JP Morgan, and Bank of America all downgraded Nike stock. Three of Wall Street's biggest banks. Today, Nike is worth roughly $62 billion. TJ Maxx, the discount retailer, is worth almost $178 billion, nearly 3 times as much. And the bad news doesn't stop there. Converse revenue is down. Earnings have fallen sharply. China is still shrinking. Tariffs are expected to cost Nike around $1.5 billion a year. Then came perhaps the clearest sign of all. Nike's own CEO told investors that the worst quarter of the turnaround was still ahead. CEOs almost never say that unless they have no other choice. None of these numbers cause Nike's problems. They simply reveal them. For decades, investors treated Nike like a company that couldn't lose. Now, they're waiting for it to prove it can win again. In October 2024, Nike pressed the reset button. John Donahoe was out. His replacement wasn't another technology executive or another outsider. Instead, the board picked someone who already knew exactly what Nike used to be. Elliott Hill, a Nike veteran who had spent more than 30 years inside the company. In fact, he'd already retired. Nike literally asked him to come back. That alone tells you something. The company didn't believe it needed a better manager. It believed it needed someone who remembered what made Nike, Nike. Hill's strategy is called Win Now. Unlike the previous plan, it's surprisingly simple. Go back to doing the things that worked. Nike returned to Amazon. It rebuilt relationships with Foot Locker. It strengthened ties with Dick's Sporting Goods. It started reducing production of Air Force Ones, Dunks, and Air Jordan Ones. Not because those shoes are bad, because they became too easy to buy. Scarcity only works if things are actually scarce. And there are some encouraging signs. North America returned to growth. Wholesale sales improved. The running category, which On and Hoka had been dominating, grew around 20%. For the first time in a long while, there was at least some good news. But before we declare the turnaround complete, it's worth remembering something. Brands don't lose trust overnight. And they don't earn it back overnight either. Nike can reopen relationships. It can launch new shoes. It can spend billions on marketing. What it can't do is force people to care. Because while Nike has been rebuilding, its competitors have been building. Hoka has become a fixture in running stores across America. New Balance has transformed itself from a practical shoe into a genuinely desirable brand. They're not placeholders anymore. They're competitors. Real ones. And they're not going anywhere. That's the challenge Elliott Hill has inherited. He isn't trying to rebuild a business. He's trying to rebuild desire. And that's much harder. When people talk about companies that fail, they usually point to an outside force, a new technology, a new competitor, a changing market. That's not this story. Nike built one of the strongest brands the world has ever seen. Then, step by step, it weakened the very things that made it special. It made iconic shoes easier to buy. It walked away from the retailers that helped build the brand. And while Nike was busy optimizing spreadsheets, its competitors were busy winning customers, one pair of shoes at a time. Nike didn't lose because On Running, Hoka, or Adidas suddenly became unbeatable. They executed well. But first, Nike gave them the opportunity. The CEO responsible for many of those decisions is gone. The people rebuilding Nike understand the brand far better than the people who changed it. Whether that's enough, nobody knows. The next earnings report will tell us how the turnaround is going, but it won't answer the biggest question. Because this story was never really about revenue or profit or stock prices. It was about desire. For decades, people didn't buy Nike because they needed another pair of shoes. They bought Nike because wearing the swoosh meant something. If Elliott Hill can make people feel that way again, Nike probably recovers. If he can't, nothing else will matter. Because in the end, Nike's greatest asset was never its factories, or its athletes, or even its shoes. It was making millions of people want them. Lose that, and you don't just lose customers. You lose what made Nike, Nike. Every empire has a story. Subscribe to hear the next one.